All right. On to the balance topics, people. The topics which are after your miscellaneous gross total income. Yes, after you have arrived at your gross total income, completing all the steps you have done till now, we are going to do something called as deductions. We're going to do something called as deductions. The starting point of this chapter itself starts with what is called as gross total income. Yes, two rules for you to follow before you get into chapter 6A deduction, people. Rule number one, you cannot claim a chapter 6A deduction beyond your GTI, beyond a GTI. GTI is the maximum you can claim chapter 6A deduction to. If you are going to have a deduction more than GTI, then the deduction gets restricted to GTI. You can't claim more than that. Rule number two, if you have any unexhausted chapter 6A deduction, can you carry forward? No, you can't carry forward that unexhausted chapter 6A deduction also. Rule number three, and the mandatory rule which you need to keep for exam purposes, is that you cannot claim chapter 6A on any special incomes, including capital gains. Even capital gains is not liable for chapter 6A deductions. That is the one thing which is not liable for chapter 6A deductions, and therefore you have to be very careful on it. So when it comes to chapter 6A deduction, the whole chapter 6A can only be claimed on your slab rate incomes. Please pay attention to this piece. Yes. When it comes to chapter 6A, people, from a final level topic, it is not very extremely critical. It is only some things which are handfully discussed from your double taxation relief perspective. So let's pay attention only to those topics. We'll ignore the balance of. Yes. Coming to chapter 6A, people, the first important topic for double taxation relief, your ATC, where income tax comes and says if you have made certain payments, or certain investments, then you'll be allowed for ATC deduction. Few of the items in that, people. First item is life insurance premium. If it's paid before 2012 policy, then it is 20% of sum assured. If it is after 2012, it is 10% of sum assured, and if it's after 2013, it is 15% of sum assured, provided it is a handicapped person. Life insurance is only eligible for self, spouse, children, not covered for parents. Other deductions which you need to keep in mind, people. First item is called term deposits more than 5 years. Or any kind of contribution happening to PPF, or your RPF, or any other contributions, provided it is made by self and not by employer. The next thing which you need to keep in mind is that if you are going to have ATC, then the ATC is also eligible for two more items, which is called tuition fees paid for your child education, which is up to 12th standard, or if you have any kind of repayment of housing loans. Apart from this, people, from an exam perspective, just note the fact that if you are going to make any investments, you're not able to find why they have made an investment, it is because they have done it for ATC. So if you see weird investments in exam, people, where they said they deposited money somewhere and you're not able to understand why they deposited money, the answer is ATC. That is what the logic is. The overall deduction under ATC cannot be claimed more than 1,50,000. But this section of ATC is not eligible for default tax regime. You can't claim this for default tax regime or your concessional tax regimes under company laws. 115 BAA, BAB, nothing is eligible for this deductions. Yes. Then we are moving on forward, people, to other things like ATCCC, which talks about pension fund. Not important. ATCCD is important for the current year exam because it has amendments. The provisions of ATCCD come and say when you have an NPS contribution, you have NPS contribution. Two people can contribute. One is self and one is employer. If self contribution, people, for the first 50,000 you'll get full deduction, no restrictions on that. Whatever extra you contribute, you can only claim up to 10% of your salary. Whereas if it comes to employer's contribution, you can claim 10% of the salary, where basic salary means basic plus DA forming part. But if you are under DTR, you will be given a deduction of 14% of the salary only for employer's contribution. The self contribution will be denied to you. You are not eligible for self contribution. Yes or no? Yes. If I have to link this with the PGBP and other chapters, people, the logic will remain as this. When it comes to NPS, if the salary is 1 lakh rupee, what is the salary? Salary is 1 lakh rupee. If the question comes and says this salary, employer has contributed 15,000 rupees. Couple of things will happen, people. First of all, because employer contributed 15,000, he will have a disallowance under PGBP. PGBP chapter comes and says employer cannot contribute more than 14% of salary, which means first thing people, when the employer claims this as a deduction under PGBP, income tax will come and clarify, not allowed as deduction, you can only allow 14,000 as deduction, because the whole 15,000 is sitting in P&L, you will disallow 1,000 rupees. You will disallow 1,000 rupees. This will happen from employer perspective. From employer perspective. Coming from the employee perspective, people, because you have been given a deduction for employer, it is now taxable in the hands of employee only to the extent of 14,000 rupees, because that is what was allowed in the hands of employer. So 14,000 rupees will be taxable under the head salaries for the employee. Separately, people, when you come to section 80 CCD, I will come and ask you, tell me, are you following DTR or are you following ATR? If you say you're following DTR, I will give you deduction of full 14,000, but if you're opting for ATR, I'll give you deduction of 10,000 rupees only. 10,000 rupees only. That is what would happen. Yes. So when it comes to 80 CCD, people, three places impact will happen. One for employer under PGBP, one for employee under salaries, and then for employee under deductions. That is what you need to keep in mind, people. Now this is all for only the employer's contribution. For the employer's contribution, if the question comes and says employee has contributed 66,000, is there anything to do with employer? No. Anything to do with employer salary? No. Which means this will directly be under chapter 6A. If you are under DTR, people, like I said, what will happen? First, 50,000 allowed as deduction. For the balance 16,000 rupees, people, you can maximum contribute 10% of salary. Salary is 1 lakh rupees, so you can contribute 10,000 rupees, and therefore overall deduction for employee will become 60,000. Overall deduction for employee will become 60,000. Whereas if you are in DTR, this is not for ATR, this is for DTR. Yes, for DTR, people, self contribution is not allowed as deduction. So DTR will become 0, ATR will become 60,000. 50,000 for first 50,000. The balance will be allowed for 10% of salary. Yes or no? Yes. So please pay attention to this one, people. Compulsory questionnaire, you will get a question. The compulsory question will have a question which will come and say employer has contributed 16% of salary. 16% of salary. You will come and say you can only claim 14%. The balance 2% will get disallowed. Clear, everyone? Yes. After 80 CCD, people, you have other items called 80D. Now rules and all not to be followed. Don't worry about the rules. The logic is very simple. 80D gives you a maximum deduction of 25,000 for each bucket being self, spouse and dependent children. Second bucket is parents. Yes, so each bucket gets 25,000. So my bucket gets 25, parents bucket get 25. But if any bucket has a senior citizen which is a resident, you get 50,000 for that bucket. Focus attention here, people, that you only get 50,000 when the person is a resident senior citizen. You will get a double taxation relief question. In the double taxation relief question, they may come and say that your parents are non-residents with an age of 68. In which case parents will get only 25,000, they will not get 50,000. So please pay attention to that piece alone. Yes, what are the items and all is not important. You don't need to be tested on that. Exam will not test you on those critical items. Yes, but just to understand, you get deduction for medical insurance, you get deduction for CGHS, your preventive health checkup up to a maximum of 5,000 rupees, in which only preventive health checkup can be paid by cash. Everything else has to be paid other than by cash. You can also claim medical expenses only for resident senior citizens, provided it has been informed that the resident senior citizen does not have a medical insurance. That is what 80D looks like. 80D again not eligible for DTR, only covered under ATR. Yes, then we have 80DD and 80U, which is talking about handicapped people. If you are going to maintain a handicapped people, flat deduction of 75,000, severe disability becomes 1,25,000. Please notice this is a flat deduction, meaning it does not matter how much you expend, you will get a flat deduction of 75 plus 1,25,000. This section is also not eligible under DTR, Then we have 80DD and DDB. We have section 80DDB, which talks about medical treatment for specified diseases. Limit is 40,000 and 1 lakh rupees in case treatment is for resident senior citizen. Not eligible under DTR. Then we have 80E. This is the one thing which has been tested in your non-resident taxation, where section 80E comes and says if you are going to take a education loan for higher education, after plus two, all your graduation courses, for all those graduation courses, if you take an educational loan, then whatever interest you pay on that educational loan will be allowed as deduction for the next 8 years, only for loans taken for self, spouse, children, and any guardian children, that is what the rule is. But ATE is also not allowed under DTR. Next items are 80 EE and EE has never been tested in finals. I am ignoring this off, you don't need to read this. EEB also has been expended, but it comes and says any kind of interest on loan taken for electric vehicles, you get a flat deduction of 1,50,000 if you have spent that much. Yes, so it's a maximum deduction of 1,50,000, not eligible under DTR. Then comes your ATG, people. From here is what your provisions relating to company start. Yes, until now all provisions were individual related provisions, but from here starts your company related provisions. The first company related provision being ATG, which talks about donations in 4 categories: category A, category B, category C, and category D. Category A talks about 100% deduction without any limits. Category B talks about 50% deduction without any limits. Category C talks about 100% with the qualifying limit of 10% of adjusted GTI, and category D talks about 50% of the qualifying limit, which is 10% of adjusted GTI, where adjusted GTI means take your slab rate income minus all deductions except this ATG, full categories, except this ATG, all categories A, B, C, and D, ignore all the 4 and do your adjusted GTI. Of that number, 10% is what you can donate, that number you have to then donate and then decide on category C or D. If it is C, then you get 100%. If it is D, you get 50%. Please notice that the 10% is not the deduction amount. 10% is the donation amount. On that, if it is a donation of category D, it becomes 50%. So please pay very small attention to that, because this is what ICA tests. For your ATG to be satisfied, people, 2 rules to be followed. You cannot make donations in kind. Second is, if you're making donations in monetary terms, it can only be up to 2,000 in cash. Everything else has to be paid by permissible modes. You will get a question in ATG where they'll give you donations in cash. Please ignore it off. Yes, after ATG comes ATGGB and GGC. ATGGB and GGC comes and says any kind of donation made to political parties will be fully allowed as deduction, except if payment is made by cash. ATGGA talks about all donations made to scientific research if it is not claimed under 35. If it is not claimed under 35, in that case you can get 100% deduction here, except if the payment is happening more than 2,000 in cash. ATG, GGA, GGB and GGC also not allowed under any special regimes, only allowed for normal regimes. Then we have GGC, people, you can ignore it off, not coming for exams. From here starts your heading number C, which talks about income based deductions. For you to do an income based deduction, rule number 1 is that you need to file your ITR on time. If you don't file your ITR within the due date, the heading C will be not allowed to you. In that, the first and the most important section from exam perspective, section 80JJA. Yes, this is the only section which is eligible for both the regimes, whether you're going for normal regime or you're going for special regime, you will be getting a deduction of 80JJA. To know this 80JJA, people, only steps to follow. First, you should have a business. This business should have a tax audit. There should be an increase in employment. Whatever increase in employees you have, take those employees, ignore all the employees where PF is paid by government or there is no PF. Then ignore all those employees where emoluments are more than 25,000 per month. Then ignore all those employees who have worked for less than 240 days or 150 days in case of leather footwear or apparels industry. Yes, if then add all those employees which are less than 240 in last year but 240 and 150 in the current year, you will get the list of employees which are eligible. Then multiply that by the salary of the employees, ignoring all your retirement benefits and ignoring all payments which have happened by non-permissible modes. You will get the salary which is payable. Multiply the employee with the salary, you will get the additional employee cost. You get a deduction of 30% of this additional employee cost for 3 years starting this year. This is what you need to know from 80JJA. From ICI perspective, people, this same rules will apply whether it is new business or old business, it doesn't matter. Yes, the rules will apply the same. Ideally it will be different when it comes to practical world, but from exam perspective, even if it's the first year of business, you will have to follow all these conditions. You'll have to follow all these conditions. Like I said, just follow the steps will answer the question for you. Yes, 80JJA eligible under both the regimes. Then we have 80QQB and RRB. This is one thing which is always tested in non-resident taxation. You will get a question of non-resident taxation with QQB and RRB only. Yes, this section comes and says that when you have any royalty received from books or inventions, royalty received from books or inventions, whatever royalty you receive will be taxable under the head PGBP or IFOS, but then you will get a deduction of 3 lakh rupees under 80 QQB or 80 RRB, 80 QQB or 80 RRB. Some conditions to be followed, people. If you are going to receive royalty from outside India, you need to receive the money within India within 6 months from the end of the previous year. Whatever royalty you are receiving should not exceed 15% of the gross revenue. 15% of the gross revenue. If you are receiving more than 15%, the whole amount will be taxable under PGBP, but I will give deduction only for 15%. I will only give deduction for 15%. So the steps to be followed are as follows, people. Step number 1, whatever royalty you have, tax it in PGBP. Step number 2, whatever royalty you have received, allow deduction only up to 15%. Step number 3, restrict this to all the amount which is received within 6 months from the end of the previous year. Step number 4, whatever amount you have, reduce the expense which you have already claimed under PGBP or IFOS. Step number 5, whatever answer you have, that versus 3 lakhs, whichever is, this is your deduction. This is your deduction which is eligible under QQB or RRB. Again, these sections are only applicable if you are following alternate tax regime, will not be applicable if you are following default tax regime. Yes, after that you have your business specific deductions, people. From here I told you nothing will be tested in exam as such. Nothing will be tested in exam as such, so you cannot pay attention to except for one item, which is section 80P, which talks about cooperative societies, where section 80P talks about cooperative society and comes and says, when you have a cooperative society, people, if they are engaged in the business of banking, cottage, marketing of agricultural produce, purchase of agricultural produce, processing of agricultural produce, disposal of labor, fishing and other allied pursuits, primary cooperative agricultural society supplying any kind of food and milk products, then you will be eligible for deduction of 100% of the profits and gains. But some rules to be followed, people. The following incomes earned by cooperative society will also be treated as zero, fully allowed as deduction if they have received any kind of interest and dividend income from investments in other cooperative society. Notice, it should be dividends and interest from other cooperative societies, meaning it should be between such societies. If you are getting interest and dividend from shares and all those things, those are taxable. Second, income from letting out of godowns or warehouse to other commodities. Any kind of income from HP or interest on securities can be fully claimed as deduction if the GTI does not exceed 20,000 and the housing society is not it is not an housing society or urban consumer society or society carrying on transport business. People, point number 3 not important because GTI is 20,000. That is never going to happen in your exams. Yes. So things you need to keep in mind is, people, if you are going to have tradings with other cooperative societies, incidental income from that also will be allowed as deduction. No deduction for any cooperative society other than primary agricultural credit societies and primary cooperative banks. But any cooperative society earning income from activities other than these can claim a general deduction up to 50,000 or 1 lakh in case of consumer cooperative societies. So whatever interest and dividends you have from normal shares and all those things will be allowed as deduction only up to maximum of 50,000 extra. This is what you can do. Questions on this is also there in your question bank. Please try and solve. This has come in exam multiple times. You have to give this deduction also. Again, people, ATP not eligible under special regimes. You can ignore all other deductions, people. Nothing else is being tested. Then moving on forward, people, to the next item which is there in non-resident taxation, 80TTA and 80TTB, which comes and says that if you are going to have any interest income from savings account or post office savings account, you get a deduction under 80 TTA to a maximum of 10,000 rupees. But if you are a resident senior citizen, you will have 80 TTB where you get deduction for all interests. Meaning including FD and RD up to a maximum of 50,000 rupees. Again, people, every time in this whole syllabus, wherever I use the word senior citizen, I only mean resident senior citizen. Watch out for the fact that if you get an exam question where the person is a non-resident, never assume he is a senior citizen. Always assume he is normal citizen, which means he will get 80 TTA. This 80 TTA and TTB again is not eligible if you are opting for default tax regime. default tax regime. That is what the provisions are. Yes, case laws relating to chapter 6A not important from exam perspective. You can let it go. From an exam perspective, people, if I have to clarify this once again, the whole chapter 6A is not eligible for deduction under special regimes except for 80JJA and 80LA, which is IFSC unit, Ideally, IFSC has never been tested in exam, so not important. But yes, two of the items which are eligible for deduction under chapter 6A. If you are an individual, then you also get two more deductions, which is 80CCD employer's contribution and 80CCH government's contribution. One other item, people, which probably I missed out is ATM. ATM is also eligible if you are going for special regimes. Yes or no? Yes. These are the provisions when it comes to chapter 6A deduction. Clear? Everyone good to go? Yes. Smaller topics for you people. After this is your tax holiday of 10AA, which comes and says if you are opting for normal regime, and not going for special regimes, you have something called section 10AA deduction if you are having a SEZ unit. For your exams, people, the only year which is applicable is after 5 years, which means for your exam the deduction is 50% of the export profits, where export profit means profits of only the SEZ unit into ETO of the SEZ unit divided by TTO of the SEZ unit. This is what the section says. So it's profit into ETO by TTO only of the SEZ unit. You can ignore all the unit sites. You can ignore all other units. This is again a deduction section, people, meaning you can only get this deduction if there is gross total income. For you to get this deduction, people, certain rules to follow. Rule number 1, you need to file your return on time. Rule number 2, you cannot get this deduction if you're opting for special regimes. You only get this deduction if you're opting for normal regimes. Rule number 3, they're coming and saying if you want to get this deduction on time, your export turnover should be received in India within 6 months from the end of the previous year, or even if you're not receiving it in India, you should have collected the money and kept it in a bank account maintained outside India with an approval of RBI. But income tax also comes and says if you have incurred any expenses like telecommunication charges and all those charges which are paid outside India and are not collected back in India with export turnover, then that amount will be reduced from your export turnover and total turnover. It will be reduced from both. So any expenses paid outside India, if paid from the export turnover, thereby not receiving the money in India, that amount will be reduced both from ETO and from TTO. That is what your section 10AA deduction talks about. Yes, we discussed about it when we did this piece. TTO has to be reduced with all your expenses paid outside India. DTO also has to be reduced with all the expenses paid outside India. Yes, 10AA case law basically comes and says when a fluctuation in foreign exchange was solely relating to export business, then whatever money you earned out of this is also profit derived from SEZ unit and therefore will be eligible for 10AA deductions. That is what it clarifies. Yes. Apart from this, people, income tax says if you are going to have a deduction under 10AA after 10 years, then you also get a 50% of export profit deduction, subject to the condition that you invest this money in SEZ reinvestment reserve, which is only used for the purpose of buying assets. That is what it says. Yes, you should use the asset only for buying new plant and machinery. New plant and machinery is what the rule is. You cannot use this money for distributing dividends in India or for doing any creation of assets outside India. Only buying assets in India is what the rule is. People understand when it comes to 10AA, income tax comes and says it is eligible for both manufacturing and for service sector, provided the work is happening from SEZ location. But sometimes it may so happen, people, that your employees are deputed in the client's place to work. Does that mean you're not eligible? You are still eligible. Circular comes and clarifies for all software development industries where the employee has been deputed in client location, but the business operations are happening from SEZ location, it is still eligible for deduction. This is what your 10AA talks about. Yes or no? Yes. Great. After 10AA, people, comes your MAT provisions. This is something which is normally tested in your question number 1, your compulsory question. If they don't want to give you a very heavy total income question, they can give you a MAT related question. Please note that MAT itself is not eligible if you are opting for special tax regimes of 115BAA, BAB, BAC and all those things. Yes, you will only get this MAT provisions if you are going for normal tax regimes. Yes, these provisions of MAT basically come and say that if you are going to report your income under normal rates and pay tax on normal provisions, but because you have claimed some big deductions because of which I'm not able to justify the turnover of India, I will ask you to pay tax under MAT at the rate of 15% of the book profits, 15% of the book profits, which is computed as per accounts, So this provision comes and says, take your P&L of accounts, make some adjustments which I will tell you, and then you will arrive at your book profits on which you have to pay 15% tax, 15% tax or your actual tax, whichever is higher. If you end up paying tax under MAT, that extra tax which you paid will be called as MAT credit, which can be carried forward for a period of 15 years to be set off in the year in which your normal tax is higher, to the extent the normal tax is higher. But at any point of time after credit set off of MAT, you should not end up paying lower than actual MAT. So you can only set off to the extent the credit is up to MAT. That is what the rules are. Yes, to remember how to remember MAT provisions, people, income tax comes and says, do nothing, people. Just take your profit as per books. And don't make any changes. Some items which I will tell you will be made changes to, which means here you're not starting from total income, you're starting from net profit of the P&L. Some items which we discussed earlier, people, items to be deleted first is all your income tax which is paid, or any provision for tax which is created in the P&L, and any kind of deferred tax liability, because you are disallowing deferred tax liability, you can claim deferred tax assets. Second on the screen, people, any amount which is transferred to reserves, ideally this amount should not be there in P&L as per accounts itself, but if you are transferring anything from reserves from P&L, that will get disallowed because it's not an expense. On the contrary, if you are moving any amount from reserves to P&L, that will also not be taxed, that will be reduced. Point number 3 says, any kind of provision for contingent or uncertain liability will get disallowed. On the same terms, if any provision is reversed, that will get allowed. Then you have any kind of provision for loss of subsidiary companies will also get disallowed. People, all these items, if you notice itself, are all notional items. Then any kind of dividends paid or proposed should be there from balance sheet, but if it is showing in P&L, you will disallow. Any kind of expenditure relating to exempt income, people, if it is already exempt under income tax, I would reduce it from my net profit. Corresponding expense will also get disallowed. So exempt income will get claimed and expenditure will get disallowed. Next, you have expenditure relating to AOP BOI. Again, people, if share of profits from AOP BOI is exempt because AOP is paying tax at MMR. If AOP is paying tax at MMR, then the share of profit will become exempt. The corresponding expense will also get disallowed. And then you have expenditure relating to foreign companies for capital gains, interest, dividend, royalty, which is taxable under 115A, provided the tax payable on such income is less than 15%. People, with current year amendment happening on capital gains, going forward, if you get a question in exam of a non-resident foreign company doing MAT provisions, and the question comes and says the person has a long-term capital gains, you will say that income is exempt, will get reduced because capital gains is taxable now at 12.5%. But please don't do this if it is short-term capital gains, because that is at 20%. 111A will become taxable at 20%. Yes or no? Yes. So which means, people, from current year, if you notice, if you have any kind of long-term capital gains and you're a foreign company, MAT provision says exempt. Meaning if it's an income reported, you will claim it as deduction. If it's a loss reported, you will disallow. So please pay attention to that piece once. Yes. Apart from that, items, people, like royalty, FTS and all, already tax rate is 20%. So therefore it will not apply here. Which means that will continue to remain as it is. The only thing which will apply in this provisions are long-term capital gains. Nothing else will come in this. Clear? Yes. Then we have something called as notional tax on transfer of SPV to business trust in exchange for units. Yes. So if you have any notional losses from transfer of units from SPV to business trust, corresponding income will also get exempted. Then you have expenditure relating to royalty taxable under 115 BBF, because people section 115 BBF comes and says royalty will only be taxable at the rate of 10%, will only be taxable at the rate of 10%. So income of that will be exempt. Expenditure on that will also get disallowed. After that you have depreciation, which is debited to P&L, will get disallowed, but the same depreciation will again get allowed as deduction. Please do not allow depreciation as per income tax. It is depreciation as per accounts. You will disallow the depreciation, you will again allow the same depreciation. You will again allow the same depreciation unless and until the question says depreciation is from revalued assets. Unless until the question says depreciation is from revalued assets. So you will disallow the full depreciation under P&L, but claim as deduction only depreciation relating to normal cost of acquisition. Don't allow depreciation relating to revalued assets. Then you say any kind of provision for diminution in value of assets, any kind of profit from retirement of revaluation reserves, any kind of actual gains will get added back, because notional loss has got disallowed. Actual gains will get taxed off. Yes or no? Yes. The next things to be kept in mind, people, from a less perspective, what we have discussed is already there. One extra thing you can claim as deduction is, people, all your past year loss or unabsorbed depreciation, whichever is lower, can be claimed as deduction under MAT provisions. But this loss and unabsorbed depreciation should be as per accounts, not as per income tax. In this whole chapter there is no income tax, there is only accounts. So allow the business loss or unabsorbed depreciation, whichever is lower, as per accounts. But if you are found out to be a company which is in insolvency, income tax says in that case you can claim both business loss and UD together. You don't need to do whichever is lower. That is what the provisions of less will come and say. So if I have to summarize this whole thing once again for you quickly, people, income tax says take the net profit, disallow all your provisions which are notional in nature, disallow all your provision for taxes which are anyway not allowed, add back depreciation as per P&L, claim depreciation as per P&L only to the extent it is not pertaining to revaluation of assets. Any kind of expenditure which is any kind of income which is exempt will get exempted under MAT also. Any kind of expenditure for this exempt income will get disallowed. Any kind of AOP income which is exempt will also get exempt. Any kind of expenditure on that will also get disallowed. Finally, any kind of notional items which is there in P&L will get removed, and any kind of actual items will get included. Please notice one thing which ICAI loves to test you in exam multiple times is something called provision for gratuity. Where the question will come and say provision for gratuity is based on a valuation report. People, allowed, not allowed? Allowed as deduction. Because it is ascertained liability. There is nothing unascertained in this. Provision for gratuity will get allowed as deduction even if the payment has not happened within the due date, because this is MAT provisions. It does not matter. That will only get disallowed under 43B under normal provisions. Provision for gratuity in this chapter is a ascertained liability. Which means items which will not get allowed in provisions are tax, contingent liabilities, provision for bad debts. These are the only three items which will get disallowed as unascertained items. Other than that, any other provision will be considered as deduction, which means if it is there in P&L already, you will ignore it off. You will not touch it. Yes or no? Yes. At the same time, people, please pay attention to the fact that in this section it does not matter what provisions of PGBP are. Even if the question comes and says the person has made the payment in cash, you will allow it. Even if the question says the person has not done TDS, you will allow it. Even if the question says the person has not made the payments on time, you will allow it. It doesn't matter. Only these items which we discussed are going to be considered for the purpose of MAT provisions. Yes or no? Yes. Apart from this, people, income tax comes and says if you are going under Ind AS, income tax says then you have some other items to make. Item number 1, if there is any item under OCI, tell me whether it is item of OCI which can be subsequently reclassified to P&L or not be reclassified to P&L. If it can be reclassified on a subsequent date, you will ignore it off. But if it can't be reclassified to P&L, you will take that into consideration. If it's a loss, allow as deduction. If it's an income, you will add it to tax, except if it is loss, if it is a revaluation happening from assets except it is revaluation happening on demerger, or if it is any kind of notional gains or losses happening on foreign exchange, which is passed through OCI. Basically, only take actual items. If there is notional items in your OCI, you will ignore those off also. At the same time, people, income tax says if it is the first year of Ind AS, if it is the first time adoption of Ind AS, whatever amount you put in transition reserve can also be taken into consideration over the next 5 years, in which transition comes and says you have to take all your transition amounts except those amounts which are from revaluation items, those items will get ignored and will not be considered. Yes, so for your revaluation transition period, people, you will not consider these items. Any amount which is made in capital reserve, any adjustment made in securities premium reserve, items which are in OCI which are classifiable to P&L on a subsequent date, all your revaluation surplus, any kind of gain or loss which is to be done on OCI based on fair valuation concept, any kind of intangible assets recorded at fair value, any kind of adjustment to investments and translation difference of foreign operations, or any kind of taxes relating to these items. Basically, again, people, take only those items in transition reserve which are actuals. Ignore all those which are provisions and notional or fair values That is what the provisions are with regards to MAT. Ideally, MAT provisions, transition reserve and all may not be tested now because it's been a while. But if you get a MAT question, you will definitely get questions where they'll come and say the person has not payment made on time, the person has done TDS defaults, there is a penalty. People, if the question says there is a penalty paid to government and that is there in the net profit, they ask you to compute MAT, you will ignore it off because it is allowed as deduction. I am not in PGBP. It does not matter. Only items to be ignored of, to be disallowed is provisions which are unascertained, any kind of tax payments and notional items, all provisions and notional items to be deleted off. Any kind of exempt income will be claimed as deduction. That is all matters. Anything else in MAT is not relevant. Anything other than that matter is not relevant. Clear? Yes, this is your MAT provisions, people. Good enough to go. Two case laws for you to keep in mind, people. First is that income tax comes and clarifies when it comes to MAT provisions, the rules will apply the same as any other law. Meaning, if you don't pay MAT on time, you can still be liable for interest, penalty and late filing fees. All provisions will apply as it is. Second thing, people, which is done by Madras High Court, where they come and say if you have any kind of exemption under section 54 EC, that also can be claimed as deduction, because the provision comes and says you can claim all other provisions of the act. So therefore, any kind of exemptions, if it is there under 54 EC, can be claimed as exemption. Here also, from an ICI standpoint, they are coming and saying this is the only exemption which I will allow. Any other exemptions will not be allowed. So this is the only exemption to be kept in mind. Clear? Yes. Last topic for us, people, before we close for today, we are looking at what is called as AMT. As much as MAT is applicable on companies, AMT is applicable on individuals, HUFs and firms. This section comes and says AMT will again not apply if you're opting for default tax regimes. AMT provisions works a little differently from MAT, people. AMT provisions come and say do one thing: start from total income. Ignore three items. Item number one, any kind of section 10AA deduction. Item number two, any kind of heading C of chapter 6A, except for section 80P, which is cooperative society. Deduction remains as it is. Apart from that, any heading C deductions will be fully denied, which is 80 JJAA, 80 IAC, IAB, IAJ, all those things will be ignored off. And finally, any deduction claimed under section 35 AD, which is specified business, but because you are disallowing the capital expenditure on section 35 AD, you can claim depreciation on these assets. If you end up doing that, people, you'll arrive at something called as adjusted total income. Income tax says AMT will be at the rate of 18.5% of this adjusted total income, unless and until you are a cooperative society, in which case it becomes 15%, and if you are in IFSC, it becomes 9%. That is what the provisions are when it comes to AMT. Baki rules will remain the same, people, which means AMT tax or normal tax, whichever is higher. But if you end up paying AMT tax, you get AMT credit to be set off in the year in which you have normal tax. To the extent you have AMT, to the extent you have AMT, up to a maximum period of 15 assessment years. For this AMT to apply, people, income tax says that you have two things to be considered. One is you should have claimed any of these deductions. AMT will not apply unless you have any of these deductions. You have any of these deductions. At least one of these deductions should be there in your P&L. Then only you will be allowed for. Then only you have to check for AMT provisions. Second is income tax says if you are an individual or a HUF, then these provisions will not apply to you if your adjusted total income, this number is less than 20 lakhs. Is less than 20 lakhs. That is what the rule comes and says. Yes, from an exam perspective, people, if a question comes and the question comes and asks compute tax liability in the manner which is most beneficial to the assessee, in the manner which is most beneficial to the assessee, you will be given three options: default tax regime, alternate tax regime, AMT. Default tax regime, alternate tax regime, AMT. You will do ATR or AMT, whichever is higher, that will be compared with DTR, whichever is lower. That is your final tax payable. That is your final tax payable. So you will do all the three, then compare normal with AMT, whichever is higher, and then the final answer will be compared with DTR, whichever is lower. This logic will remain the same in MAT computation also, people. In MAT computation also, it is normal or MAT, whichever is higher, compared with concessional tax, whichever is lower. Compared with concessional tax, whichever is lower. That is how your AMT will look like. Yes, examples we have done on AMT credit, people, like I clarified to you earlier also. Clear enough with this? Any doubts on this piece? Are we good enough to go? Yes, this is your provisions of AMT and MAT as well.